what was going on, let's say in 2020 to 22, which is roughly 3 to 5 years ago, was a lot of money printing, a lot of capital chasing deals, a lot of what I would call like end of cycle, very high pricing, and a lot of financial engineering by sponsors to back into, let's say, 15% plus IRR targets to attract investors. And in order to do so, there was a lot of financial engineering in the capital stack. And what I mean by that is that there were a lot of deals, almost all the deals had a preferred return layer because they had to make sure they can raise enough money. Most of the deals, especially in apartments, were floating rate bridge loans. So if you were going to invest in anything, you almost had to invest in that if you were like hell bent on investing. I didn't invest in any of it, but if you wanted to invest in anything, you almost had no choice. And that created such a concentration risk for investors, meaning that if those blew up, everybody was going to get burned. And that's what's happened on the LP side. So now what we're seeing is a big exit of LPs, or at least a lot of LPs, certainly at the very least, questioning why aren't those deals performing to projections? Why did my cash flow stop? Why am I getting capital call? Why is this getting foreclosed?
Yeah.
Which was not in any of the business plans that they read. Just a huge. It's almost like going from one end of the spectrum to the other in the past 3 to 5 years.